The complete story of KKR, one of the most influential private equity firm in the world. The year was 2008, and the world was watching as the global financial system teetered on the edge of collapse. Lehman Brothers had just filed for bankruptcy on September 15, sending shockwaves through every corner of the financial markets. Banks were freezing, credit markets had seized up completely, and panic was spreading like wildfire across Wall Street. Most investors were paralyzed with fear, desperately trying to figure out how to survive the carnage. But at the offices of Kohlberg Kravis Roberts & Company, known to the world as KKR, a different conversation was taking place. Henry Kravis and George Roberts weren't asking how to survive. They were asking what they could buy. This wasn't bravado or recklessness. This was the culmination of more than 3 decades of preparation for exactly this kind of moment. While other firms scrambled to shore up their balance sheets and calm panicked investors, KKR had spent years building a war chest of dry powder, capital ready to deploy when others couldn't. They had structured their funds to be patient, with 10 to 12-year time horizons that meant they didn't need to sell in a panic. They had cultivated relationships with management teams and company owners who would call them first when they needed a partner with both capital and expertise. Within weeks of the Lehman collapse, KKR was deploying billions of dollars. They weren't bottom fishing or making distressed bets. They were doing what they had always done best, buying good businesses at temporarily depressed prices and helping management teams navigate through the crisis. They acquired Dollar General for $4 billion, seeing an opportunity in discount retail as consumers tightened their belts. They invested in energy infrastructure, knowing that regardless of the financial crisis, the world would still need power. They put capital to work in healthcare, in technology, in manufacturing. Each investment followed a playbook refined over decades. This moment in 2008 revealed everything that made KKR different from its competitors. It showed their discipline in raising and deploying capital. It demonstrated their relationship advantage built over 30 years. It proved the value of their long-term orientation and patient capital structure. Most importantly, it revealed their fundamental insight about private equity, that the best time to invest is when others can't or won't. This wasn't the first crisis KKR had turned into opportunity, and it wouldn't be the last. To understand how they could act with such conviction while the world burned, you need to understand where KKR came from and what made them see the world differently than everyone else. The story of KKR begins not in 2008 but more than 3 decades earlier, in a very different financial world. The year was 1976, and America was in the midst of profound economic uncertainty. The post-war boom had given way to stagflation, that toxic combination of stagnant growth and rising inflation that confounded economists and policymakers alike. The Vietnam War had ended in defeat just a year earlier. President Nixon had resigned in disgrace in 1974. The dollar had been taken off the gold standard in 1971, and oil shocks were wreaking havoc on the economy. Interest rates were rising, inflation was accelerating toward double digits, and the stock market was going nowhere. The Dow Jones Industrial Average stood at around 1,000 points, the same level it had been at a decade earlier. In this environment of malaise and uncertainty, corporate America was struggling. Many established companies were underperforming, weighed down by bureaucracy, diversification strategies that made no sense, and management teams that prioritized growth over profitability. Conglomerates were in fashion, with companies buying unrelated businesses simply because they could. The idea was that professional managers could manage anything, but the reality was that most of these sprawling empires were destroying value. Public markets weren't working well either. Valuations were depressed, trading volumes were low, and institutional investors were conservative and risk-averse. Into this world stepped 3 men who would change the landscape of American business forever. Jerome Kohlberg Jr. was 51 years old in 1976, a veteran of Bear Stearns where he had spent more than 2 decades. Kohlberg had pioneered something relatively new on Wall Street, the leverage buyout. The concept was simple but powerful. Instead of just advising companies on mergers and acquisitions, why not buy companies yourself using mostly borrowed money, improve their operations, and then sell them for a profit? The leverage amplified returns, and if you chose the right companies and managed them well, the returns could be extraordinary. Kohlberg had done a handful of these deals at Bear Stearns in the late 1960s and early 70s, and they had worked remarkably well. He had developed a specific approach. Look for good businesses with strong cash flows, businesses that could support debt. Buy them at reasonable prices, usually from families or companies looking to divest divisions. Install strong management teams and give them ownership stakes to align incentives. Let the business generate cash to pay down debt. Then exit after several years, either through a sale or by taking the company public again. It was a formula that made sense, but it required patience, operational expertise, and access to capital. Bear Stearns was willing to do these deals, but they were a small part of a large investment bank, and Kohlberg chafed at the constraints. Working with Kohlberg at Bear Stearns were two younger protégés who shared his vision. Henry Kravis was 32 years old in 1976, the son of a successful oil engineer from Tulsa, Oklahoma. Kravis had grown up in comfortable circumstances, attended elite schools including Claremont McKenna College and Columbia Business School, and joined Bear Stearns in 1970. He was smart, driven, and ambitious, with a competitive intensity that set him apart. Kravis had learned the leverage buyout business from Kohlberg and proven himself to be a natural dealmaker. He had the ability to see value where others didn't, to structure complex transactions, and to convince management teams and lenders to back his vision. George Roberts was also 32 in 1976, and he was Henry Kravis's first cousin. Roberts had grown up in Houston, Texas, where his father ran a successful investment firm. Like Kravis, he had gone to elite schools, in his case Culver Military Academy and then Claremont McKenna College, where he and Kravis were fraternity brothers. Roberts had joined Bear Stearns in 1969, a year before Kravis, and had also been mentored by Kohlberg. Roberts was the quieter, more analytical counterpart to Kravis's deal-making intensity. He was meticulous in his financial analysis, conservative in his risk assessment, and deeply focused on operational details. Where Kravis was the public face making deals happen, Roberts was often the one ensuring the numbers worked and the businesses performed. By 1976, all three men had become frustrated with Bear Stearns. They wanted to do more leverage buyouts, but the firm was cautious and bureaucratic. They wanted to raise a dedicated fund to make these investments, but Bear Stearns wasn't interested. They believed the leverage buyout business could be much bigger than anyone realized, that there were hundreds of underperforming companies that could benefit from their approach. They saw an opportunity to build something new, a firm dedicated entirely to buying and improving businesses using leverage and operational expertise. In May of 1976, they made the decision to leave Bear Stearns and start their own firm. The founding of Kohlberg, Kravis, Roberts and Company was both audacious and modest. Audacious because they were betting their careers and reputations on an unproven business model. The leveraged buyout industry barely existed in 1976. There were perhaps a handful of people in the entire country doing this kind of work, and there was no established playbook for how to build a firm around it. They would have to figure out everything from scratch, from how to raise capital to how to source deals to how to add value to the companies they bought. The risks were enormous. If their investments failed, they would lose not just money but their professional reputations. If they couldn't raise capital, the firm would collapse before it started. If management teams or lenders didn't trust them, they wouldn't get access to deals. But the founding was also modest in its initial scale. They started with just the three partners and a small amount of capital. Their first office was a tiny space with a handful of employees. They didn't have a massive war chest or an established brand. What they had was their track record from Bear Stearns, their relationships with management teams and lenders, and their conviction that the model could work. The partnership dynamics were clearly defined from the start. Kohlberg, as the eldest and most experienced, would be the senior partner and strategic thinker. Kravis, based in New York, would lead deal-making on the East Coast and serve as the public face of the firm. Roberts, based in San Francisco, would lead deal-making on the West Coast and focus on operational execution. They split the economics relatively evenly, though Kohlberg had a slightly larger share as the founding partner. The name itself was significant. Kohlberg, Kravis, Roberts. Alphabetical order, no hierarchy implied, three equal partners building something together. They called it KKR for short, a name that would eventually become synonymous with private equity itself. But in 1976, it was just three guys with an idea, trying to prove that buying companies with borrowed money could create enormous value if done right. What they couldn't have known then was that they were about to ride and help create one of the most transformative waves in business history. Over the next 45 years, KKR would complete some of the most iconic deals ever done, would pioneer techniques that became industry standard, would generate hundreds of billions in returns for investors, and would fundamentally reshape how corporate America operates. The first challenge was raising capital. In 1976, the concept of a dedicated private equity fund was virtually unknown. Most institutional investors, pension funds, and endowments were extremely conservative. They invested primarily in stocks and bonds, and the idea of giving money to three guys to buy entire companies using massive amounts of debt seemed crazy. The partners needed to convince skeptical investors that this model made sense, that the returns would justify the risks, and that they were the right people to execute it. Kohlberg, with his grey hair and gravitas, was critical in these early fundraising efforts. He could speak the language of institutional investors, could explain the strategy in terms they understood, could point to the successful deals they had done at Bear Stearns as proof of concept. Their first fund, raised in 1976, was tiny by today's standards. They raised just $31 million, primarily from a handful of wealthy individuals and families who believed in the partners' vision. But that $31 million, combined with borrowed money, gave them the ability to do several deals. And those first deals would prove the model and enable them to raise much larger funds in the years ahead. From the very beginning, KKR had a clear investment philosophy that would guide them for decades. They would focus on cash flow positive businesses, companies that generated steady cash that could be used to service debt. They would avoid turnarounds or speculative bets. They wanted good businesses with strong management that just needed better capital structures and strategic direction. They would use leverage intelligently, borrowing money to amplify returns but not so much that the companies were at risk of bankruptcy if things went wrong. They would typically target debt-to-equity ratios of around 70-30 or 80-20, meaning 70 to 80% of the purchase price came from borrowed money and 20 to 30% came from their equity fund. They would partner with management teams, giving executives meaningful ownership stakes in the companies they ran. This alignment of incentives was crucial. If management owned a significant piece of the business, they would work harder, make better decisions, and focus on long-term value creation. They would be patient, holding companies for 5 to 7 years on average, long enough to make real operational improvements and for the debt to be paid down. And critically, they would add value beyond just financial engineering. Yes, leverage amplified returns, and yes, the tax deductibility of interest payments helped economics. But KKR believed their real edge was in helping companies improve operations, cut unnecessary costs, focus on their core businesses, and make smarter strategic decisions. This operational value creation would become the secret weapon that separated KKR from competitors and enabled them to generate superior returns over decades. Their first deal after founding KKR set the template. In 1977, they acquired AJ Industries, a small manufacturing company, for $26 million. It wasn't glamorous, but it had steady cash flows and a solid market position. They worked with management to streamline operations, focus on profitable product lines, and improve working capital management. Within a few years, they sold the company for a significant profit. The playbook worked. The late 1970s saw KKR complete a series of successful deals, each one building their reputation and proving their model. They bought Hyundai Industries, a diversified manufacturing company, in 1979 for $370 million. This was a much larger deal, and it required more sophisticated financing and operational work. They worked with Hyundai's management to sell off underperforming divisions, focus on core businesses, and improve profitability. The investment ultimately generated strong returns, further validating their approach. What was becoming clear was that KKR had developed something unique. They weren't just financial engineers moving money around. They were building a systematic approach to buying and improving companies, a repeatable process that could generate consistent returns. But the real test came in the 1980s, as the leveraged buyout industry exploded and KKR faced both enormous opportunities and fierce competition. The early 1980s marked a turning point for KKR and for the entire private equity industry. Several factors came together to create a golden age for leveraged buyouts. First, the economy began to recover from the stagflation of the 70s. Paul Volcker, the Federal Reserve chairman, had raised interest rates to crushing levels in the early 80s to break inflation, and it worked. By 1983, inflation was coming down, the economy was growing again, and corporate profits were rising. Second, the regulatory environment became much more favorable. The passage of the Employee Retirement Income Security Act, or ERISA, in the late 70s eventually led to a reinterpretation that allowed pension funds to invest in alternative assets like private equity. This opened up an enormous pool of institutional capital. Third, the high-yield bond market, also known as the junk bond market, took off. Michael Milken at Drexel Burnham Lambert pioneered the use of high-yield bonds to finance leveraged buyouts, providing a source of capital beyond traditional bank loans. This made it possible to do much larger deals than ever before. Fourth, corporate America was ripe for restructuring. Many companies were underperforming, bloated with unnecessary costs and unfocused strategies. Shareholders were increasingly frustrated with mediocre returns. There was a growing sense that American companies needed to be shaken up, that managers needed to be more accountable, that assets needed to be redeployed more efficiently. Leveraged buyouts became a mechanism for forcing this change. Into this environment, KKR stepped with confidence and aggression. They had spent the late 70s refining their model, building relationships, and establishing credibility. Now they were ready to do bigger deals and take on more complex challenges. Throughout the early and mid-1980s, KKR completed a series of increasingly large and sophisticated transactions. They bought Lilly Tulip Cup Company in 1980, Marley Company in 1981, and Fred Meyer in 1981. Each deal reinforced their reputation as disciplined investors who could execute complex transactions and deliver returns. But the deal that really put KKR on the map was Beatrice Companies in 1986, though this came after several other important transactions that built their capability. Before we get to Beatrice, it's important to understand how KKR's investment process worked by the mid-1980s. When they looked at a potential acquisition, they started with cash flow analysis. Could this business generate enough cash to service the debt they would put on it? They would build detailed financial models projecting cash flows for 7 to 10 years under various scenarios. They were conservative in their assumptions, assuming modest revenue growth and leaving room for things to go wrong. Next, they would assess the business quality. Did the company have defendable competitive advantages? Was it a leader in its markets? Did it have strong customer relationships and brand value? Were the assets valuable? Could parts of the business be sold if needed? Then they would evaluate management. Was the existing team capable? Would they stay under new ownership? Were they hungry and motivated? Could they handle the pressure of high leverage? Management quality was often the deciding factor. A great management team could overcome challenges and create value even if everything didn't go perfectly. A weak management team would struggle even if the business fundamentals were strong. KKR also thought deeply about value creation opportunities. What could they do to improve this business? Cost reductions were usually the easiest to identify and execute. Were there redundant facilities, excessive overhead, underperforming divisions that could be sold? But they also looked for revenue growth opportunities. Could the company expand into new markets, launch new products, or gain market share? The firm had developed a network of industry experts and former executives they could call on for due diligence and operational support. Before acquiring a company, they would bring in people who knew the industry inside and out to validate their thesis and identify risks and opportunities they might have missed. This operational due diligence became a hallmark of the KKR approach. Finally, they would structure the financing carefully. How much debt could the business safely carry? What mix of bank loans, high-yield bonds, and seller financing made sense? What covenants and protections did they need? What ownership stake would management get? How would governance work? Every deal was custom-tailored to the specific company and situation. By the mid-1980s, this systematic approach had generated consistent success. KKR's funds were generating returns well above public market benchmarks, their investors were happy, and they were able to raise increasingly large pools of capital. In 1984, they raised a fund of $1 billion, a staggering amount at the time. This gave them the firepower to go after much larger targets. And that's when they set their sights on Beatrice companies. Beatrice was a massive, sprawling conglomerate with dozens of food brands and international operations. It had revenues of over $12 billion and employed over 100,000 people around the world. But it was exactly the kind of company that KKR believed they could improve. Beatrice had grown through acquisition, buying company after company without a clear strategic logic. The result was a hodgepodge of businesses that didn't create synergies and a corporate bureaucracy that stifled the individual operating companies. The stock was underperforming, and shareholders were frustrated. Management was under pressure but seemed unable or unwilling to make the dramatic changes needed. KKR saw an opportunity. In 1986, they acquired Beatrice for $6.2 billion, the largest leveraged buyout in history at that time. The acquisition was complex, requiring multiple layers of debt financing and careful negotiation with management and the board. But KKR had done their homework. They had a clear plan for how to create value. The strategy was straightforward but required disciplined execution. First, they would sell off underperforming or non-core businesses, using the proceeds to pay down debt. Beatrice owned dozens of companies that didn't fit together. By selling these piecemeal to strategic buyers, they could realize values that weren't reflected in Beatrice's conglomerate stock price. Second, they would empower the management teams of the remaining core businesses, giving them more autonomy and ownership stakes. These were often great brands that had been held back by corporate bureaucracy. Third, they would cut corporate overhead dramatically. The massive headquarters staff in Chicago wasn't adding value. Most of those costs could be eliminated. Fourth, they would improve operations at the core businesses, applying best practices and focusing on efficiency and profitability. Over the next several years, KKR executed this plan methodically. They sold off division after division, including international operations, smaller food brands, and unrelated businesses. Each sale brought in cash to pay down debt and simplified the remaining company. They cut corporate staff by over 80%, slashing hundreds of millions in annual costs. They worked with the management teams of the remaining businesses to improve operations, reduce working capital, and focus on their strongest products and markets. The results were impressive. By the early 1990s, KKR had paid down most of the debt, sold or spun off most of the businesses, and generated returns that far exceeded their initial projections. The Beatrice deal proved that KKR could handle massive, complex transactions and create enormous value through operational improvements and strategic focus. But even as they were executing the Beatrice deal, KKR was working on an even larger and more audacious transaction that would define their legacy and become the most famous leveraged buyout in history. The acquisition of Nabisco in 1989 would test everything they had learned, push the limits of leverage and deal complexity, and ultimately generate both enormous returns and lasting controversy. Nabisco was one of the largest and most profitable companies in America in the late 1980s. The company had been formed through the merger of R.J. Reynolds Tobacco and Nabisco brands, creating a giant with leading positions in both cigarettes and food. It owned iconic brands like Winston, Camel, Salem, Oreo, Ritz, and many others. The company generated billions in cash flow from its tobacco business, and the food businesses were also highly profitable. But despite these strengths, the company was underperforming. The stock price had been stagnant for years, and shareholders were frustrated. The CEO, Ross Johnson, was a controversial figure known for his lavish lifestyle and questionable strategic decisions. In October of 1988, Johnson shocked Wall Street by announcing that he and a group of investors, backed by Shearson Lehman Hutton, would take Nabisco private in a leveraged buyout. Johnson proposed paying $75 per share, a significant premium to the current stock price. But the announcement triggered a bidding war, as several other parties saw an opportunity to acquire this trophy asset. KKR had been watching RJR Nabisco for months. Henry Kravis and George Roberts believed the company was exactly the kind of target where they could create enormous value. It had strong cash flows to support leverage, well-known brands, market-leading positions, and significant opportunities to improve operations and reduce costs. When Johnson announced his bid, KKR immediately entered the fray. What followed was a 2-month battle that became legendary on Wall Street and was later chronicled in the best-selling book Barbarians at the Gate. The bidding war pitted KKR against Johnson's management group, with each side raising their offers and accusing the other of various transgressions. The board of RJR Nabisco, led by special committee, tried to maximize value for shareholders while navigating the complex dynamics. The bids kept escalating. KKR offered $90 per share, then $94, then $108. Johnson's group matched and exceeded, going to $112. The back and forth was intense, with billions of dollars at stake. Finally, in late November of 1988, the board announced that KKR had won with a bid of $109 per share, valuing RJR Nabisco at $25 billion. This was the largest leverage buyout in history by a huge margin, nearly 4 times larger than the Beatrice deal. The transaction required piecing together one of the most complex financing structures ever created, involving bank loans, high-yield bonds, bridge loans, preferred stock, and equity from KKR's funds. The debt load was staggering, over $20 billion. But KKR was confident they could make it work. They had a detailed plan for how to extract value from RJR Nabisco. First, they would sell off underperforming or non-core assets to raise cash and pay down debt. RJR Nabisco owned various international operations and smaller brands that could be divested. Second, they would dramatically cut corporate overhead and eliminate wasteful spending. Ross Johnson had run the company with legendary extravagance, including a fleet of corporate jets and lavish perks. All of that would go. Third, they would focus the remaining businesses on their core strengths, investing in the most profitable brands and markets while cutting support for weaker products. Fourth, they would improve operations across the board, applying the best practices and efficiency measures that KKR had developed over years of operational work. The early years of KKR's ownership of RJR Nabisco were challenging. The enormous debt load meant the company had to generate massive cash flows just to service interest payments. There was little room for error. The management team, led by Lou Gerstner, whom KKR had recruited, worked tirelessly to execute the value creation plan. They sold international operations, cut costs aggressively, and focused the business on its strongest products. But several external factors made the situation more difficult than anticipated. The cigarette industry faced increasing regulatory pressure and public health concerns. Smoking rates were declining, and litigation risks were growing. This put pressure on the tobacco business, which generated most of RJR Nabisco's cash flow. The high-yield bond market collapsed in 1989 and 1990, making it much harder to refinance debt or raise additional capital. Interest rates rose, increasing the cost of servicing the debt. The economy went into recession in 1990 and 1991, hurting consumer spending and putting pressure on the food businesses. These challenges led many observers to predict that KKR had overpaid, that the debt burden was unsustainable, and that the deal would end in disaster. Media coverage was often negative, portraying KKR as greedy financiers who had loaded up a great American company with debt for their own profit. The term "Barbarians at the Gate," from the book about the deal, became shorthand for everything people disliked about leverage buyouts and Wall Street excess. But KKR persevered, and ultimately the RJR Nabisco investment proved successful, though it took much longer than they expected. Over the course of the 1990s, KKR gradually paid down debt, sold assets, and repositioned the remaining businesses. They took the food business public as Nabisco Holdings in 1993, realizing significant value. They eventually sold the tobacco business to Japan Tobacco in 1999 for over $8 billion. When all was said and done, KKR's investors earned solid returns on the RJR Nabisco investment, though not the spectacular multiples they had achieved on earlier deals. The internal rate of return was around 15 to 20% depending on how you calculated it, good but not exceptional given the risks taken. The RJR Nabisco deal had complex and lasting implications for KKR and for the private equity industry as a whole. On one hand, it demonstrated that KKR could execute extraordinarily complex transactions, could manage enormous debt loads, and could create value even under difficult circumstances. The fact that the deal ultimately succeeded despite all the challenges validated their operational capabilities and their long-term orientation. On the other hand, the deal marked a turning point. The sheer size and leverage of the transaction, combined with the negative publicity, contributed to a backlash against leveraged buyouts. Politicians and regulators began scrutinizing the industry more closely. The market for mega deals dried up for several years in the early 1990s. Within KKR itself, the RJR Nabisco deal created some tensions. Jerome Kohlberg, the founding partner, had become increasingly uncomfortable with the direction the firm was taking. He believed they were doing deals that were too large, using too much leverage, and moving away from the patient, relationship-focused approach that had defined their early success. In 1987, Kohlberg had left the firm, in part due to disagreements about strategy and in part due to health issues. His departure was amicable but signaled a philosophical divide. Henry Kravis and George Roberts, now the sole leaders of KKR, were more aggressive and willing to do larger, more complex deals. They believed the firm needed to evolve and grow to remain competitive. The early 1990s were a period of reflection and adaptation for KKR. The mega deals of the late 80s had generated mixed results and significant criticism. The firm needed to demonstrate that they were more than just financial engineers, that they were builders of businesses and creators of real value. They also needed to adapt to a changing environment. The junk bond market had collapsed, bank lending had become more conservative, and public sentiment toward leveraged buyouts was increasingly negative. In response, KKR made several strategic shifts. First, they began to focus more explicitly on operational value creation rather than financial engineering. They hired teams of operational experts, former CEOs, and industry veterans who could work with portfolio companies to improve performance. They developed playbooks for different industries, identifying best practices and proven strategies that could be applied systematically. Second, they became more patient and long-term oriented. Rather than trying to flip companies in 3 to 5 years, they were willing to hold investments for 7 to 10 years or longer if that's what it took to maximize value. This longer time horizon allowed them to make investments in growth, technology, and capabilities that would pay off over time. Third, they expanded beyond traditional leverage buyouts into other strategies. They launched growth equity funds to invest in companies that didn't need restructuring but did need capital to scale. They moved into distressed investing, buying troubled companies or debt at discounts. They explored international opportunities, particularly in Europe and Asia where private equity was less developed. Fourth, they institutionalized their investment process even further, creating more structured due diligence protocols, more rigorous financial modeling, and more systematic post-acquisition value creation plans. Throughout the 1990s, KKR rebuilt their reputation through a series of successful investments that demonstrated their operational value creation capabilities. One important example was Borden, a diversified food and consumer products company they acquired in 1995 for $2 billion. Borden was struggling, with too many underperforming brands and a weak competitive position in most of its markets. KKR worked with management to divest weaker brands, focus resources on core products, streamline operations, and improve efficiency. Over several years, they transformed Borden from a struggling conglomerate into a focused, profitable business. When they exited the investment, they generated strong returns for their investors. Another significant investment was PrimeDeer, a media and information company. KKR saw opportunities in specialized business information, education materials, and enthusiast magazines. They helped PrimeDeer acquire and integrate various properties, building a diversified media portfolio. They invested in technology to improve content delivery and customer service. The investment benefited from the growth of specialized media and information services in the 90s, and KKR ultimately realized significant gains. These and other investments in the 90s showed that KKR could create value across different industries and situations. They weren't dependent on financial engineering or excessive leverage. They had built genuine operational capabilities that allowed them to improve businesses and generate returns even in challenging environments. By the late 1990s, the private equity industry was changing again. The economy was booming, driven by the internet revolution and the dot-com bubble. Valuations were rising across all asset classes. Competition for deals was intensifying as new private equity firms launched and existing firms raised larger funds. The leverage that had been the hallmark of 80s-era LBOs was back in fashion, with lenders eager to finance deals. KKR was well positioned to capitalize on this environment. They had maintained relationships with management teams, investment banks, and lenders throughout the lean years of the early 90s. They had capital to deploy from their latest funds. And they had the operational capabilities to add value beyond just putting companies on their balance sheet. They completed several large transactions in the late 90s, including the acquisition of Amphenol, an electronics components manufacturer, and Windsor Nixdorf, a German technology company. But they also made a strategic decision that would prove prescient. Even as the market got frothier and valuations climbed, KKR remained disciplined about the prices they would pay and the amount of leverage they would use. They passed on numerous deals where they felt the valuations didn't make sense or where the risks were too high. This discipline meant they missed out on some of the wild returns that more aggressive firms generated during the boom years. But it also meant they avoided the catastrophic losses that came when the bubble burst. The dot-com crash of 2000 to 2002 was devastating for many investors. Technology companies that had been valued in the billions saw their stock prices collapse to pennies. Entire business models were revealed to be unsustainable. Many venture capital and growth equity firms suffered massive losses. KKR, with its focus on cash flow positive businesses and moderate leverage, weathered the storm relatively well. They had minimal exposure to pure internet plays and technology speculation. Their portfolio companies, concentrated in traditional industries like manufacturing, consumer products, and healthcare, continued to generate cash and service their debt. Some investments struggled during the recession that followed the dot-com crash, but none failed catastrophically. This period reinforced several lessons that would guide KKR through subsequent cycles. First, discipline matters more than market timing. By sticking to their valuation criteria and avoiding overpaying, they preserved capital and positioned themselves to invest when opportunities improved. Second, cash flow and profitability are real. Companies that generate actual profits and cash can weather storms. Companies built on growth projections and future promises often collapse when reality intrudes. Third, leverage is a double-edged sword. Moderate leverage amplifies returns without creating undue risk. Excessive leverage can destroy otherwise good businesses when conditions deteriorate. Fourth, operational capabilities are critical. The ability to work with management teams to improve performance, cut costs, and adapt strategies is what separates successful private equity firms from financial speculators. As the 2000s began, KKR was entering a new phase of its evolution. Henry Kravis and George Roberts, now in their late 50s and early 60s, were still actively leading the firm but also thinking about succession and long-term sustainability. They had built KKR into one of the most successful and respected private equity firms in the world, with a track record spanning more than 25 years. But they faced several strategic questions about the firm's future. First, how should they continue to evolve their investment strategy? The core leveraged buyout model remained their bread and butter, but were there other opportunities they should pursue? Second, how should they think about firm structure and governance? KKR had always been a partnership, relatively flat and informal. But as they grew larger and more complex, did they need more formal organizational structures? Third, how should they approach succession? Kravis and Roberts wouldn't lead forever. Who would be the next generation of leaders, and how should they develop and empower them? Fourth, how should they balance growth and focus? There were opportunities to expand into new geographies, new asset classes, and new strategies. But would expansion dilute their culture and capabilities? These questions would drive KKR's evolution through the 2000s and into the 2010s. They made several important decisions during this period. First, they decided to institutionalize the firm by going public. In 2007, KKR completed an initial public offering, though structured as a private partnership initially before converting to a corporation. Going public provided permanent capital, created a public currency for acquisitions, and helped with succession planning by creating clear equity ownership. It also brought more transparency and scrutiny, which had both benefits and costs. Second, they expanded their investment strategies significantly. They launched or grew practices in growth equity, distressed investing, infrastructure, real estate, and credit. They believed their operational capabilities and relationship networks could create value across multiple strategies, not just traditional buyouts. Third, they invested heavily in building a true investment platform. They hired specialists in different industries, built data and analytics capabilities, created formal operating partner programs, and developed proprietary tools and processes. They wanted to systematize and institutionalize their edge so it didn't depend solely on a few senior partners. Fourth, they expanded internationally, particularly in Asia. They saw enormous opportunities in the growing middle-class markets of China, India, and Southeast Asia. They opened offices, hired local teams, and adapted their playbook to different cultural and regulatory environments. These strategic moves positioned KKR for the next phase of growth, but they also changed the firm's character. From a relatively small, partnership-driven firm built around personal relationships, KKR was becoming a large, diversified alternative asset manager with thousands of employees and operations around the world. Some of the informality and personal touch that had characterized the early years was inevitably lost. But the firm worked hard to maintain its culture and core principles even as it scaled. The 2008 financial crisis was the ultimate test of everything KKR had built. As described in the opening of this story, KKR entered the crisis in a position of strength. They had raised large funds in the mid-2000s, but they had been disciplined about deployment, passing on deals where valuation seemed stretched. As a result, they had significant dry powder, capital ready to invest. When Lehman Brothers collapsed in September 2008 and credit markets froze, KKR was one of the few firms with both the capital and the confidence to invest aggressively. They moved quickly, deploying billions in the months following the crisis. The Dollar General acquisition in November 2008 for $7 billion was emblematic of their approach. Dollar General was a profitable, cash-generating business serving value-conscious consumers. In a recession, discount retailers tend to perform well as people trade down from more expensive options. The company needed capital to grow and modernize, and the founding family was willing to sell at a reasonable valuation because credit markets had frozen and other buyers had disappeared. KKR provided the capital, worked with management to improve operations and accelerate store openings, and helped position Dollar General for the recovery. Over the next several years, Dollar General's performance was exceptional. Revenues and profits grew steadily, the debt was paid down ahead of schedule, and the company's value increased dramatically. When KKR took Dollar General public again in 2009 and subsequently sold down their stake, they generated one of the best returns in their history, multiple times their original investment in just a few years. Dollar General wasn't the only crisis-era investment that paid off. KKR invested in energy infrastructure, healthcare companies, financial services, and other sectors where they saw dislocations and opportunities. Many of these investments were made at valuations that looked very attractive in retrospect as markets recovered in the 2010s. The 2008 crisis validated several aspects of KKR's approach. First, their dry powder discipline. By not deploying all their capital at the peak of the market in 2006 and 2007, they preserved the ability to invest when opportunities were best. Second, their long-term capital structure. Because their funds had 10 to 12-year lives and patient investors, they didn't face redemptions or forced selling during the crisis. They could be buyers when others had to be sellers. Third, their operational capabilities. The crisis created not just valuation opportunities but also operational challenges. Companies needed help managing through the recession, preserving cash, and positioning for the recovery. KKR's ability to work with management teams to navigate these challenges added real value. Fourth, their relationship network. Many of the best crisis-era opportunities came to KKR because management teams, banks, or sellers had long-standing relationships and trusted them to execute even in chaotic markets. As the economy recovered in the 2010s, KKR continued to grow and evolve. They expanded their presence in Asia, completing major deals in China, India, and Japan. They grew their credit platform significantly, managing billions in loans, bonds, and other debt instruments. They built out their infrastructure and real estate strategies. They continued to do traditional buyouts but also increasingly invested in growth companies and provided capital for corporate carve-outs and other situations. By the mid-2010s, KKR had assets under management exceeding $200 billion. They employed several thousand people around the world. They had offices on every continent. They were one of the largest and most diversified alternative asset managers in the world. This growth and diversification raised questions about identity and culture. Was KKR still a private equity firm, or had they become something broader? Did the culture that had made them successful in buyouts translate to credit or infrastructure? How did they maintain quality control and consistent standards across such a large and diverse organization? The firm worked hard to address these questions. They articulated core values that they believed should apply across all strategies. Things like intellectual honesty, partnership with management teams, patient capital, operational focus, and ethical conduct. They created training programs and knowledge-sharing forums to spread best practices. They tried to ensure that whether you were doing a buyout in New York, a growth equity investment in Shanghai, or an infrastructure deal in London, you were following the same fundamental principles and standards. The firm also continued to think about succession and next-generation leadership. Henry Kravis and George Roberts, now in their 70s, remained active but were gradually transitioning responsibility to younger partners. They promoted a co-CEO structure with Joe Bae and Scott Nuttall taking day-to-day leadership while Kravis and Roberts remained executive chairman. This generational transition was managed thoughtfully, with Kravis and Roberts providing guidance and support while empowering the next generation to lead. The COVID-19 pandemic in 2020 provided another test of KKR's capabilities and approach. When the pandemic hit in March 2020, financial markets collapsed. The S&P 500 fell over 30% in a matter of weeks, credit markets froze, and economic activity ground to a halt as lockdowns were imposed. It was the fastest and sharpest market decline in history, even worse in speed if not ultimate magnitude than 2008. Once again, KKR found themselves in a position to act. They had capital to deploy, strong relationships, and operational capabilities. But the pandemic presented unique challenges. Unlike the 2008 financial crisis, which was primarily a problem of excessive leverage and financial system dysfunction, the COVID crisis was a real economy shock. Revenues and profits were disappearing as businesses closed and consumers stayed home. Some industries like travel, hospitality, and retail were devastated almost overnight. Others like technology and healthcare were accelerating. KKR had to move quickly to support existing portfolio companies while also identifying new investment opportunities. For portfolio companies, they provided emergency capital, helped management teams manage through unprecedented uncertainty, and worked on strategic pivots where necessary. For some companies, this meant temporarily closing operations and preserving cash. For others, it meant accelerating digital transformation or adjusting business models. On the investment side, KKR was active in sectors they believed would benefit from pandemic-driven changes. They invested in healthcare and life sciences companies developing treatments and diagnostics. They backed technology companies enabling remote work and digital commerce. They provided capital to businesses that were temporarily distressed but fundamentally sound. As had been the case in 2008, many of the investments KKR made during the early pandemic proved very successful as markets recovered much faster than most people expected. The combination of massive fiscal stimulus, unprecedented monetary support from central banks, and the rapid development of vaccines led to a sharp recovery in both markets and the economy by late 2020 and into 2021. KKR's portfolio companies generally performed well through this period, and new investments made at the depths of the crisis generated strong returns. By 2023, KKR had assets under management exceeding $500 billion. They were one of the largest alternative asset managers in the world, alongside firms like Blackstone, Carlyle, and Apollo. They had proven their ability to perform across multiple market cycles, from the LBO boom of the 80s to the Dotcom crash to the financial crisis to the pandemic. Looking at KKR's journey from 1976 to today, several sources of their sustained success become clear. First and most fundamentally, KKR developed genuine operational capabilities. They weren't just financial engineers buying companies, loading them with debt, and hoping for the best. They built systematic approaches to improving business performance. They hired operating partners, former CEOs, and industry experts who could work with portfolio companies. They developed playbooks for different industries and situations. They created processes for identifying cost reduction opportunities, revenue growth initiatives, and strategic improvements. This operational focus meant that KKR could create value even in companies that didn't have obvious quick fixes. They could work with management teams over multiple years to transform performance. They could navigate challenges and adapt strategies when initial plans didn't work out. This capability became a true competitive advantage and separated them from less sophisticated competitors. Second, KKR maintained discipline around valuation and leverage. While they were willing to do large deals and use meaningful amounts of debt, they didn't chase deals at any price or use leverage to the point where companies were at serious risk of failure. This discipline meant they sometimes lost deals to more aggressive bidders, but it also meant they avoided catastrophic losses. Over multiple decades and hundreds of investments, the avoidance of disasters was just as important to their overall returns as the generation of home runs. Third, KKR built and maintained extraordinary relationships. Their network of management teams, investment bankers, lenders, and industry experts was cultivated over decades and gave them access to opportunities and information that others lacked. When a company needed capital or a family business wanted to sell, KKR was often on the short list of calls because of relationships built over years. These relationships were based on trust, earned through decades of fair dealing, competent execution, and partnership orientation. Fourth, KKR adapted and evolved while maintaining core principles. They expanded from pure leverage buyouts into growth equity, credit, infrastructure, and real estate. They moved from being US-focused to truly global. They went from a small partnership to a large public company. But through all these changes, they tried to maintain the core principles that made them successful. Focus on cash flow and business quality. Partner with management rather than dictating. Be patient and long-term oriented. Add value through operations, not just finance. Maintain ethical standards and treat people well. Fifth, KKR developed a long-term orientation supported by their capital structure. Their funds typically had 10 to 12-year lives, which allowed them to hold investments long enough to make real improvements and ride out short-term volatility. They didn't face redemptions or quarterly performance pressures in the way that public market investors did. This patient capital was a structural advantage that enabled better decision-making. Sixth, KKR benefited from being early and building institutional knowledge over decades. They were one of the first firms to professionalize the leveraged buyout business. This head start gave them time to learn, build relationships, develop processes, and accumulate pattern recognition that was hard for newer entrants to replicate. By the time competition intensified, KKR already had 40-plus years of institutional knowledge and experience. Seventh, and perhaps most subtly, KKR developed a culture of intellectual honesty and learning from mistakes. They were willing to acknowledge when investments didn't work out, to analyze what went wrong, and to change their approach based on what they learned. This learning orientation, rather than ego-driven defensiveness, allowed them to get better over time. Of course, not everything about KKR's history is unambiguously positive. Like all major private equity firms, KKR has faced criticism and controversy over the years. Critics argue that leverage buyouts can harm companies and their employees. The use of debt to finance acquisitions can leave companies fragile and unable to weather downturns. When investments go wrong, workers often lose jobs while KKR's investors are protected by the limited liability structure. Even when investments succeed, the cost-cutting and operational changes that drive returns can mean layoffs, wage freezes, and reduced benefits for workers. The RJR Nabisco deal remains a lightning rod for these criticisms. Thousands of workers lost their jobs as divisions were sold and costs were cut. Communities that depended on RJR Nabisco facilities suffered when operations were closed or moved. Meanwhile, KKR and its investors made billions. Critics point to this as emblematic of a system where the gains are privatized and the pain is socialized. KKR would respond that they saved RJR Nabisco from potential bankruptcy, that the company needed to be restructured regardless of who owned it, and that the remaining businesses were stronger and more sustainable after their operational improvements. They would also point to their track record of building companies and creating jobs, noting that their portfolio companies collectively employ hundreds of thousands of people and generate billions in economic value. The debate over private equity's social impact continues, with legitimate points on both sides. What's clear is that KKR and firms like it wield enormous power over the American economy, controlling companies that employ millions and shape entire industries. This power comes with responsibilities that go beyond just generating returns for investors. There are also questions about wealth concentration and inequality. KKR's partners and senior executives have become extraordinarily wealthy, with Henry Kravis and George Roberts each worth billions. This wealth was generated by charging fees on invested capital and receiving a share of profits, the carried interest, which is taxed at favorable capital gains rates rather than ordinary income rates. Critics argue this is a policy mistake that enables the already wealthy to pay lower tax rates than middle-class workers. The broader question is whether the enormous compensation in private equity is truly justified by the value created, or whether it represents a form of rent extraction from the economy. KKR would argue that their returns have been earned through skill, hard work, and taking risk with their own capital alongside investors. They would point out that their success has generated billions in returns for pension funds, endowments, and other institutional investors whose beneficiaries include teachers, firefighters, and retirees. The wealth created flows to millions of people, not just KKR's partners. Again, there are legitimate perspectives on both sides of this debate. What's undeniable is that KKR operates in a system that creates enormous rewards for successful capital allocators and that this contributes to wealth inequality in America and globally. Looking at KKR today in 2025, the firm is at an interesting juncture. They remain one of the dominant players in private equity and alternative assets, with a track record few can match. But they also face significant challenges and questions about their future. Competition in private equity has intensified dramatically. There are now hundreds of private equity firms globally, all competing for deals and trying to deploy enormous pools of capital. This competition has driven up valuations, making it harder to find attractively priced investments. The amount of capital chasing deals has also driven down prospective returns. The days of regularly generating 3 to 5 times returns on buyouts are largely over. Today, even very good private equity firms are often targeting returns in the low to mid double-digit range, more like 1.5 to 2 times multiples of invested capital. This is still attractive compared to public markets but not the extraordinary returns of decades past. To maintain their edge, KKR has had to continually innovate and find new sources of alpha. They have moved into more complex situations, like corporate carve-outs and take-private transactions, where their operational capabilities and relationship networks provide advantages. They have expanded into growth equity and venture capital, backing companies earlier in their life cycles where there are opportunities for larger multiples. They have built out their technology and data analytics, using machine learning and artificial intelligence to identify investment opportunities and improve portfolio company performance. They have also faced the challenge of managing a much larger and more complex organization. With 500 billion in assets under management and thousands of employees, KKR is very different from the scrappy partnership of the 1970s and 80s. Maintaining culture, ensuring quality control, and preserving the entrepreneurial spirit that drove early success is difficult at this scale. The generational transition in leadership is also critical. Henry Kravis and George Roberts built KKR and shaped its culture over nearly 50 years. As they step back and the next generation takes full control, will the culture and principles endure? Joe Bae and Scott Nuttall, who became co-CEOs, have been at KKR for decades and deeply understand the firm's approach, but every leadership transition carries risks. The public markets have also evolved in ways that create challenges for private equity. The rise of passive investing and index funds has made public markets more efficient and reduced the valuation gaps that private equity firms used to exploit. Technology and data availability mean that information advantages are harder to sustain. All of this means KKR has to work harder to find and create value. Looking forward, KKR's strategy seems focused on several areas. First, they are continuing to expand globally, particularly in Asia where economic growth is faster and private equity markets are less mature. They see significant opportunities in China, India, and Southeast Asia as middle-class populations grow and companies need capital to scale. Second, they are investing heavily in technology and data. They believe that AI, machine learning, and advanced analytics can provide new sources of edge in identifying opportunities, conducting due diligence, and improving portfolio company operations. They have hired technologists and data scientists and are building proprietary tools and platforms. Third, they are diversifying further into adjacent strategies like infrastructure, real estate, and private credit. They believe their operational capabilities and capital markets expertise can create value across multiple asset classes, not just traditional buyouts. Fourth, they are focused on ESG, environmental, social, and governance factors. They recognize that investors and society increasingly care about the impact that companies have beyond just financial returns. They have committed to measuring and improving the environmental and social performance of their portfolio companies and to incorporating ESG factors into investment decisions. Whether these strategies will succeed in maintaining KKR's edge remains to be seen. What's clear is that the firm has demonstrated remarkable adaptability and staying power over nearly 5 decades. They have survived and thrived through multiple market cycles, competitive threats, and leadership transitions. So what can investors and business leaders learn from KKR's nearly 50-year journey? What are the enduring lessons from their experience? First, operational excellence matters more than financial engineering. KKR's sustained success came not from clever financial structures or leverage tricks but from their ability to actually improve the businesses they bought. They helped companies cut unnecessary costs, focus on their core strengths, improve operations, and make better strategic decisions. This operational value creation is hard work and requires genuine expertise, but it's also more sustainable and defensible than purely financial plays. Second, relationships compound over decades. KKR's network of management teams, bankers, lenders, and industry experts was built through decades of fair dealing and competent execution. These relationships gave them access to opportunities, information, and resources that competitors lacked. Building deep relationships takes time and can't be rushed, but the long-term payoff is enormous. Third, discipline around valuation and leverage is critical. KKR was willing to pass on deals when prices were too high or risks were too great. This meant they sometimes lost out in the short term, but it protected them from catastrophic losses and positioned them to invest when opportunities improved. In investing, avoiding disasters is just as important as finding winners. Fourth, patience is a competitive advantage. KKR's long-term orientation, supported by their fund structure and investor base, allowed them to hold investments for 7 to 10 years or longer if that's what it took to maximize value. They didn't have to sell in bad markets or respond to short-term performance pressures. This patient capital was a structural advantage that enabled better decisions. Fifth, culture and values matter. KKR tried to maintain a culture of partnership, intellectual honesty, ethical conduct, and respect for stakeholders even as they grew. This culture helped them attract talent, maintain relationships, and avoid the scandals and blow-ups that have damaged other firms. Sixth, adaptability within core principles. KKR evolved significantly over 5 decades, expanding strategies, geographies, and organizational structure. But they tried to maintain core principles throughout: focus on business quality and cash flow, partner with management, be patient, add operational value. Adapting while maintaining core identity is a difficult balance but critical for longevity. Seventh, learning from failures is essential. KKR had investments that didn't work out, but they analyzed what went wrong and incorporated lessons into future decisions. This learning orientation, rather than defensiveness or excuse-making, allowed them to improve over time. Eighth, scale can be an advantage but also brings challenges. KKR's size gave them access to large deals and resources that smaller competitors lacked. But it also made them slower, more bureaucratic, and potentially less entrepreneurial. Managing the trade-offs of scale is an ongoing challenge. Ninth, timing and luck matter. KKR benefited from being early in the leveraged buyout business, from favorable regulatory and tax changes in the 80s, from the growth of the high-yield bond market, and from being positioned to invest during crises in 2008 and 2020. While skill and hard work were critical, good fortune also played a role. 10th, power brings responsibility. KKR and firms like it wield enormous influence over the economy and people's lives. How they exercise that power, whether they treat workers and communities fairly, whether they create broad-based prosperity or just enrich themselves, matters beyond just financial returns. These lessons apply not just to private equity investors but to anyone trying to build a successful organization or investment approach. The principles of operational focus, relationship building, discipline, patience, culture, adaptability, and learning are universal. As we conclude this story of KKR, it's worth reflecting on what their journey tells us about capitalism, finance, and American business. KKR Success demonstrates that active management and operational improvement can create real value. They didn't just shuffle ownership of assets. They helped companies perform better, which benefited workers, customers, and the economy. At their best, private equity firms like KKR are agents of productive change, forcing underperforming companies to improve and allocating capital to higher and better uses. But KKR's story also raises questions about who benefits from this value creation and at what cost. The enormous wealth accumulated by KKR's partners, the job losses from cost-cutting, the leverage that sometimes pushed companies too far, all of this reflects tensions in modern capitalism. Is private equity primarily about creating value or extracting it? Do the benefits flow broadly or concentrate at the top? Are workers and communities treated fairly or squeezed for profits? The answer is probably some of both. KKR has created genuine value and built successful companies. They have also benefited enormously from a system that richly rewards capital while often shortchanging labor. They have helped some companies thrive while others have struggled under the weight of debt and cost-cutting. Like capitalism itself, private equity is neither purely good nor purely bad but a system with trade-offs, benefits, and costs. What KKR's nearly 50-year journey proves is that sustained excellence in investing is possible but difficult. It requires operational capabilities, disciplined decision-making, strong relationships, long-term orientation, cultural coherence, and constant adaptation. It also requires some luck and good timing. KKR built one of the most successful investment firms in history not through one big bet or lucky break but through decades of consistently making good decisions, learning from mistakes, and evolving with changing markets. The test for KKR now is whether they can maintain this excellence into the next generation. Can they preserve the culture and capabilities that made them successful as they continue to grow and as founding leaders step back? Can they continue to find sources of edge in increasingly competitive markets? Can they adapt to a world with different expectations about the role of capital and the responsibilities of investors? Only time will tell. But if history is any guide, betting against KKR's ability to adapt and succeed would be unwise. They have proven their resilience and capability across nearly 5 decades and through multiple crises. That track record suggests they will find ways to continue creating value for years to come. And that is the story of KKR, from three ambitious partners leaving Stearns in 1976 to a global investment powerhouse managing over $500 billion today. It's a story of vision and execution, of relationships and discipline, of adaptation and persistence. It's also a story that reflects larger themes about American business, financial markets, and capitalism itself. Whatever your views on private equity, KKR's journey offers lessons about what it takes to build something lasting in a constantly changing world.